Hey, welcome to another video. Thanks for joining me in this particular video, I'll be talking about mutual funds and ETFs. In order to make this clear, I'll also cover a particular mutual fund and the things that you should watch out for if you're planning to invest in mutual funds in general. And also, I will talk about this ETF as well if you are planning to invest in ETFs. Now, the truth is, these two are very similar. They're investment vehicles that you can choose to put your money in, and this money will be invested by a manager. Before we get into the details of this, let me introduce myself. My name is Stephen Ojo, and on this channel we'll talk about finance and investing. And also, if you're interested in aviation subjects, I also have another channel that covers that, which I will link in the description below. If you're interested in aviation subjects, particularly about flight training or the airline pilot life in general, then you should consider checking out that channel and maybe subscribing to the channel. If you're interested in finance and investing, which I'm guessing you are, which is why you're watching this video, then stick around. And also, if you haven't subscribed yet, please consider subscribing to this channel. Now, if you're thinking of investing your money, you have different investment vehicles that you could put your money in. You can put your money in stocks of companies that you know and you believe will do well long term. You have bonds of companies that you can put your money in, or even bonds from the government that you can put your money in. Thirdly, you also have investments in things like cryptocurrencies, even though they're not really considered investments in general, but there are also ways to hold your money and let your money have some value over time. But there are other types of hybrid investments, or you call them a mix of different types of investments. Mutual funds will come to mind because mutual funds are generally a basket of stocks or sometimes bonds, and it could be a mix of all this together in this mutual fund. Now, the goal of the fund is generally stated in a prospectus, and generally the goal is always for capital appreciation. There's a professional manager that oversees the transactions that are conducted in this fund. Now, if you choose to put your money in that fund, well, you're giving your money to this manager, and this manager is pretty much trying to double your money and increase the value of the money for you over time. On the other hand, exchange-traded funds are actually similar to mutual funds. They just have very few differences. For example, how they are sold, prices, and how they are managed as well. But in reality, they are both investment vehicles that you can put your money in, and the money you put into this type of funds will be invested in different stocks of companies or bonds of companies, depending on the mutual fund you've selected or the ETF that you have selected. Now, there are a few things I would like to cover with you that I'll be sharing with you on my screen. I've actually put these two funds together side by side, and the first one that we have on the top here is the Vanguard Information Technology Index Fund, ETF, and the second one is the Fidelity Select Technology Portfolio, which is FSPTX. Now, these two funds, even though one is an ETF and one is a mutual fund, both invest in technology companies, but you can see how this performed over time. For the VGT, which is the Vanguard Information Technology Index Fund, which is an ETF, in 1 year, it is up 56.98%. In 3 years, it is up 31%. In 5 years, 30. In 10 years, 20. And life of the fund is up 13%. For the Fidelity, in 1 year, it is 69.69%, 31.3 in 3 years. In 5 years, 32.7, and in 10 years, it is 19.7, and life of the fund, it is up 14.37. So looking at the performance of this fund over time, if you put your money in this fund, say April in 2011, $10,000 in both of these funds, over time, your fund would have increased in value to about $64,000 if you put it in VGT, and about $60,000 if you put it in FSPTX, which, to be honest, that's not bad at all. But why is there a difference in these values? Okay, because even though they've performed pretty well, almost the same, even in the performance over the years, the VGT has performed more than the FSPTX. Now, there are a few reasons for that. Even though the holdings are not exactly going to be the same, the fact that these two funds have been operated in a different style. Like I said, one is an ETF, one is a mutual fund. Now, one of the things that I would like to mention to you is before you put your money in any mutual fund or ETF, always take the time to look at the prospectus of this ETF, because in that prospectus, you always see the details of that ETF or the mutual fund. Now, this is the FSPTX. We're going to look at that first, the Fidelity Select Technology Portfolio. Now, there are a few things that you want to look at, of course, if you're looking at this investment. The first one is, you can see the inception of the fund, but you can see the expense ratio is about 0.69, and we have a turnover rate of 1 107%. So the question is, what is turnover rate? Well, from what it means, it pretty much means the frequency at which stocks are traded or companies are exchanged from this fund. Now, for the FSPTX, which is a mutual fund, this is an actively managed fund. For mutual funds, they can either be managed passively or actively. Now, with an actively managed fund like the FSPTX, that means they will generally have a higher expense ratio and they will generally have a high turnover rate. Now, anything above 50% is considered high turnover rate. Now, with 107%, that is extremely high. Think about this. If this fund holds 100 companies in it, okay, and you exchange 50 companies for different companies through the year, then you have a turnover rate of 50%, which means that if you have a 107% turnover rate, that means you could end up exchanging all the companies in that fund for new companies entirely. So this will lead to two additional problems for investors. The first one is taxes, and the second one is just performance. By exchanging companies and selling and buying new companies, you will end up incurring capital gains tax. The other thing also you have to remember is that these companies will generally pay dividends, which means that you also have to worry about the dividend taxes that you have to pay on this fund. These taxes are ended up passed to investors of this fund. So you have to always keep that in mind. With a high turnover rate like this one, if this fund is held in a retirement account, then you may not have to worry about taxes at that point. But if it is held in a taxable account, then you would have to worry about taxes often. Now with VGT ETF, this is a passively managed ETF, which means that there's low turnover rate on this fund. And secondly, the expense ratio is low. As we can see here, it has an expense ratio of 0.1%. So if you go to the portfolio and management, you'll be able to see the turnover rate in this section. You can see the turnover rate of this fund is 4.8%. Now, this is a good thing, but this also comes with a price. Because the companies are not exchanged quite often, that means that over time, these type of funds will carry what they call unrealized gains. By the time they turn over the fund, say after a year, 2 years, or 3 years, could amass a lot of unrealized gains that by the time they then sell that company, that tax bill is passed to the investors, and then you are all of a sudden hit with a tax bill because the fund exchanged a company that you didn't really initiate. Of course, if you sell out of the funds as well, you also have to worry about capital gains tax, whether long-term or short-term. Before you invest in any fund, if you go to the distribution section, you'll be able to see what the unrealized appreciation or depreciation is of this asset, and also you'll be able to see what the realized capital gains or losses is. As of this date, you can see that there's a realized capital loss of $1.81, an unrealized appreciation of $171. Now, this is very important because if you then buy this fund at the wrong time and they then sell companies that have performed really well in this fund, in this ETF, then you will end up owing taxes, even though your fund hasn't really performed well to justify the expense or to justify that tax bill. So in order to see the impact of fees over time, let's see a typical scenario in which you put in $1,000 into either of these funds, and then over time you put in $5,000 per year for, let's say, 10 years. For FSPTX, $1,000 investment made into that, $5,000 over 10 years, and with a return of 15.97. Where did I get a number from? I got it from the prospectus of that ETF, which is here. As we can see, it says return after taxes on distribution and sale of fund shares is about 15.97 after the taxes have been accounted for in this fund. Now, of course, you have to also remember that this is not all the taxes, because that number would always change depending on your tax bracket. Because if you take dividends, if this is investment in a taxable account, the dividends that are taken out that you are paid will be taxed at your income level. So if we calculate that, you can see that here the ending value is around $787, with fees costing about $5,000. Now for the same example, but now we're going to look at the Vanguard VGT ETF prospectus here. Let's see. So you can see the return after taxes on this one and distribution sales of funds is about 14.85. Now 14.85 with an expense ratio of just 0.1. And we can see that this comes out to be $119,037 with fees just costing $698. From the first one, where ending value is $122,787 and fees costing about $5,000. VGT, fees costing $698. with an ending value of more than $19,000. Now, it is obvious that fees can really hit away a lot of money that you put into these funds. As you can see, performance of VGT has actually exceeded the performance of the FSPTX, even though the FSPTX, you would think because of the higher fees, should perform better and is actively managed. That is not the case, because VGT, which is passively managed and is an index, has actually performed way better than the FSPTX. Consider looking at various investments before you invest. Look at the fees, look at what the performance truly are at the end of the day, because that will determine how your money will perform. I hope that you found value in this video, and I hope that you've given this video a thumbs up. Please go ahead and do that if you haven't done that yet. I really appreciate your support, and thanks for watching.